Good morning, good afternoon, and good evening, everyone. Welcome to the Abaxx Q3 Project Development Update and Q2 Quarterly Financial Call. During this call, I'll be referencing disclosures from our Q2 financial statements published on SEDAR last week, our business update and milestone press release dated August 16th. And if any questions, we're also happy to cover items from our management information circular and proxy materials posted to SEDAR yesterday ahead of our September AGM. Joining me on the formal part of the call is Abaxx Chief Economist Dave Greely, who will be adding a short commodity market commentary and a few notable references from our client engagement over the past quarter. Also on the call with me today are Chief Commercial Officer Joe Rea and CFO Steve Frey, who will be available in the Q&A section of the call. And I do apologize, but I'm feeling a bit under the weather here in Colorado this morning. So please bear with me as we have many exciting updates to discuss. As we laid out on last quarter's call, although we will endeavor to provide project milestone updates at or around the time of our quarterly financial and MD&A filings, these calls will not necessarily be a formal presentation of our financials, but instead an opportunity to engage directly with our shareholders in the financial analyst community. We will dive into key development milestones and answer investor questions on our go-to-market strategies and the risks heading to the launch of our exchange, and in the future quarters provide more information and sneak peeks around our software technology innovations as well. So with that background, I want to reemphasize our regular disclosures on forward-looking statements and specifically reiterate that the nature of our business undertakings are subject to many development timelines and infrastructure complexities that are also dependent on ecosystem partners, not least of which is being subject to final regulatory approvals. So kicking things off, I'd like to emphasize that the month of July was probably the most important month of client and strategic engagement that we've had since starting the company. And the market infrastructure we're developing in LNG, carbon, and battery metals is, of course, becoming a high-stakes discussion on the global stage. I couldn't be more pleased that the Abaxx commercial team, and their market leadership and market education and the way they keep elevating the SmarterMarkets mission within the global energy trading community. But keeping pace right there with them, during the month of August, our entire technology team, operations team, and risk management has been adding resources and grinding all summer to ready this business for the client demand that's waiting. There's an urgency to our mission, and I'm very proud of the way that the entire global team is pulling together ahead of an important fall period. So jumping into the milestone discussion, as disclosed in our press release last week, there were three highlight categories which we'd like to spend a bit more time on this morning. First off, the commencement of the Abaxx Exchange launch planning with our commodity industry partners and the FCM commercial onboarding. Second, some exciting commodity product updates for the exchange. And third, our corporate finance updates, specifically some of the advanced planning that we've started around additional stock exchange listings for Abaxx shares and our disclosure of strategic interest and a process we will look to engage this fall. And before we jump into the specifics of these topics, I also want to point out that we plan to engage with shareholders more frequently over coming months as we come out of an intense heads down period the last 6 months with our exchange technology platform enhancement, which was an important lead time item that required advancing prior to setting a new launch timeline and commencing these commercial launch activities. Given the increased global stakes of what we're building since the European energy crisis started last fall, to use an auto racing analogy, we made the tough call earlier this year to go into the pit for some fresh tires and gear ahead of our launch sprint, a move that we believe will pay off for shareholders over the short, medium, and long term. So beginning with launch planning, we were very pleased to update shareholders last week on our progress this summer with FCM onboarding in our core group of FCMs. We had signaled last quarter that we had identified a core group of FCMs during our market engagement over the course of the last 2 years. And in June, July, we have moved a handful of those highest priority FCMs into our process outline for membership onboarding, ISV software connectivity, and now advancing the system towards testing. That said, at times our public company disclosure timelines don't align perfectly with our project announcement timelines, especially during the financial community's holiday season of mid-August. So we're not fully prepared with our FCM partners to put a formal launch date timeline on the exchange this week. But we are moving into that preparation window given the increased pull of energy client demand and market needs. and tempering ourselves by the system testing of our new platform infrastructure that we started in late Q1. As alluded to in the PR, there's a busy commercial season approaching. What I refer to as the back to school season coming up here in September, with a number of key global energy industry events, including the global gathering of LNG market participants at APEC in Singapore. So we are planning all aspects of the project for a formal release of a target launch date this fall. Also, given the gap between formal launch announcements and the press release we put out last week, we need to be a little bit careful with not forecasting announcements or undisclosed aspects of the launch in our Q&A. So I'd like to preempt most of that discussion here, and I'll go into some further detail on our pre-launch milestones in line with our previous milestone disclosures in our annual information form that's up on SEDAR. Again, we will be communicating with our shareholders in the broader market over the next 6 to 10 weeks as we move through these key milestones. So on the systems front, as discussed in our previous 2 calls, we made the decision earlier this year to upgrade our overall trading and clearing systems, adding additional capabilities to our exchange and clearinghouse stack so that we could provide a more dynamic and agile risk system, as well as more modern cloud-based architecture that positions us to lead innovations in real-time physical collateral delivery and smart contract to settlement once the industry is ready for this new technology. Again, all of these features may not be part of our core initial launch, but we want to be making sure that we have them natively in the stack as the industry rapidly evolves in digital transformation. We've been receiving key sprint deliveries with additional software over the course of the summer, and then anticipate completing end-to-end testing of the full trade lifecycle this fall. Tested will be conducted hand-in-hand with FCM partners that we're in the process of onboarding, and is designed to validate the full stack, from our core matching engine, trade settlement, and clearing systems, all the way through our proprietary middleware, our zero trust identity protocol, and third-party APIs, including settlement messaging. Remember, our industry is at a turning point, one that Abaxx has been anticipating building towards for years, and we're looking forward to serving market participants with smarter tools to manage risk at a time when risk has never seemed so abundant. Next, we'll turn our attention to the risk model assessment and approvals for funding minimum contributions to the guarantee fund. Lead times here can typically drive about a 4 to 6 month process depending on the clearing firm and their technology dependencies. And we've been staggering the start of those processes accordingly. I can say that a few of our FCMs are quite motivated by the growth and opportunity in the energy transition market specifically, and in Asia more broadly. And so the approach from their top executives has been encouraging in terms of wanting to move quickly towards a launch timeline. On regulatory milestones, we're preparing to take down our full licenses in the coming quarters, with the RMO exchange licenses drawing down probably 2 to 3 months before final ACH clearinghouse license. But again, I caution that this has not yet been confirmed with the MAS, and we are working on that roadmap communication with them now. During a year when firms worldwide have been shedding talent, we've been growing our team, ramping up headcounts and operations, risk and technology, and expanding the team responsible for building the full ecosystem of the Abaxx Exchange and Abaxx-related tools as we prepare to launch. Our velocity has increased dramatically, and I've personally never been more excited to see our vision coming to life. We have a lot to look forward to over the coming quarters, and I can't wait to share many exciting updates through the rest of 2022 and into 2023. Again, we'd be happy to clarify any of these milestone comments on the Q&A, but I caution that both for competitive reasons as well as being probably 4 to 6 weeks out from some key information, it's probably better to update the market more broadly over the course of the fall. Turning to our product updates, we disclosed that we'll be submitting additional physical delivery commodity products to the MES this quarter. We continue to advance our LNG delivery contracts within the rapidly evolving global gas market, taking lessons from and reacting to the dynamic commercial realities of LNG and the energy crisis in Europe and Asia. While aspects of this extended launch timing have tested the patience of some, I want to emphasize that we are now in a position to launch a far more comprehensive market structure, as the LNG market has transitioned from long-term contracts to spot markets over the past few years, and now today's crisis and buyer and seller of last resort volatility. Our critical focus on this shifting market structure at this juncture should serve the community well, positioning Abaxx as a truly unique and, I believe, essential global market over the coming years. Turning to carbon, we had a very strong June and July in particular, engaging with the global trading community on a proposed market structure for voluntary carbon markets. While we've seen a number of global exchanges announce new voluntary market products this year, nearly all of them major exchanges, in fact, we're confident the Abaxx approach to serving this industry traders with financial tools and contracts in line with their existing commercial practices is surprisingly unique engagement approach and represents a competitive advantage we built with this team, having depth of both commodity industry and physical exchange experience. While our approach is, of course, still untested commercially, we continue to receive strong positive feedback from the market that our attention to delivery contract details and trade risk mitigation is differentiating us from the rest of the field, and that most, if not all, of the carbon index products currently being launched are more geared to our nascent financial investment industry and don't project the liquidity of commercial convergence needed by the upstream producers or downstream industries sourcing specific credits for retirement. We also announced for the first time that we've formally engaged our first battery metal contracts with the global metals and mining industry. Like some of our other products, we want to be careful with disclosing too many details on the products until the products have sufficiently advanced, given the highly competitive nature of the industry. We've also engaged a new, highly regarded trading advisor for this work. We've been pleased with the feedback from the industry so far for our detailed work in tackling the hard problems in market structure and prioritizing commercial risk mitigation first. We intend to discuss this metals project further on our next call. And one other item to point out with our metals product work is that the particular markets we're working on might provide the opportunity to debut a truly innovative market structure using ID++ signatures and our software innovations. While it's still early and will likely take a staged approach to introducing a radically different digital contract structure, first focusing on highly specific risk mitigations that this market needs, we are planning to propose to the industry a new way of trading an underlying element, which we believe is a unique opportunity to launch a first fully digital asset contract with a small, tight global market that we will likely, couldn't introduce in markets like LNG right away. We've been granted one of our first software patents this quarter related to this innovation in physical market delivery contracts. Digital contracts. I can also perhaps speak to this a bit more in the Q&A or when I talk about the broader SmarterMarkets vision in just a minute. Again, I do want to caution, this would all be subject to regulatory approval, but we are starting to see, the market readying themselves for more of this type of innovation. And last but not least, on the product list update on gold. While there's no specific update to report this quarter, that we're ready to report this quarter, I would like to point out that David Greely hosted an excellent podcast on SmarterMarkets this past weekend with one of our product advisors, a former chair of the LBMA. The podcast covered some of the key risks and structural problems in the gold market, hinting at some of the unique approaches we will reveal at the right time that can attract a diverse liquidity and diverse liquidity and broader market participants in the contracts once launched. So the final update I'd like to walk through before handing over the mic, and I do want to spend a bit of time on this, is our current thinking around capitalization. In our press release last week, we specifically highlighted the preparation work in considering an additional exchange listing for Abaxx shares, likely on a U.S. exchange, and we also mentioned some inbound strategic interest in our exchange and clearinghouse, which we're preparing to start entertaining this fall. So I thought I'd give this disclosure a bit more context, as there's been a number of investor questions already ahead of the Q&A. Before I address those points specifically, I think it's important to step back again and explain the unique capital structure of Abaxx and how we've capitalized our long-term vision to advance the global economy towards what we characterize as smarter markets. Our org chart is critical in understanding our strategy and our investment thesis. We did an extraordinary amount of work at the formation of the company to embed optionality in our capital structure to deliver this value to shareholders. This hard work is paying off now as it's enabling us to engage in discussions with strategic investors ahead of the exchange launch. We simply would not be in this position to have these opportunities with a consolidated single entity. So now we have multiple opportunities to incentivize liquidity in the exchange, while also assessing less dilutive financing options with industry specialists. Further, the royalty agreement between Abaxx Tech and the Abaxx Exchange, and Abaxx and base carbon, is representative of the value we're beginning to deliver to shareholders. The option of attracting industry-specific investors to either Abaxx Exchange or the base carbon spinout allows those companies to scale appropriately within their industries while generating regular revenue streams to Abaxx over the long term. To be clear, minimizing dilution to our shareholders is embedded in our culture. I'm going to elaborate more on the structure because it's central to the investment thesis. The SmarterMarkets mission, of course, is no small undertaking. Looking at it either from a microeconomic perspective of building and launching an important global energy market at this time, or from the macro perspective where we're trying to advance new technology and a whole new way of trading and pricing commodities during the digital transformation. For those that listen to our weekly SmarterMarkets podcast, you will generally be familiar with the core pillars of SmarterMarkets. First, as it relates to traditional commodities, it's about increasing transparency and market coordination, particularly in this energy transformation commodities where there aren't commercial contract standardization, common benchmarks, or competitive buyer and seller of last resort markets. This is how we facilitate more capital flowing into hard commodities and price the risk for the many trillions of dollars in hard asset investments needed to support mass electrification and reduce long-term reliance on hydrocarbon energy sources. Second, how do we put a price on social or environmental externalities so that commodity markets aren't a race to the bottom? So marginal costs for global industry aren't just set by the dirtiest resources with the highest hidden long-term costs socially, politically, or environmentally. And finally, what information technologies can advance the trust and transparency we're trying to achieve, the software and data enablers of these smarter markets. So fast forward to today, I think there's little doubt at this point that we got our LNG and energy market thesis correct. We're getting our inflation and commodity cycle thesis correct, and we're getting our blockchain thesis correct. Though I should point out that I still believe that the biggest digital transformation wave is yet to come once self-sovereign identity reaches its mainstream tipping point over the next few years. And I also believe that we reflexively added a lot more wind to the sails of our thesis through smarter markets and the thought leadership we're building across the commodity sector, even before we've commercially launched our products. So our strategy has to pursue optionality in the smarter markets vision with progressive rounds of investment, with essentially a two balance sheet structure and strategy. From our very inception, we created Abaxx Technologies, the holding company and innovation mothership of the multifaceted vision, and Abaxx Exchange, a traditional commodity futures exchange and clearinghouse. There are three primary reasons for making this balance sheet and governance level distinction in our management and corporate structure. First and foremost, focus. We needed to attract the right team with the right executives, incentives for ultimately two very different business cultures. One, we wanted to remain a cutting edge software and innovation hub. You could think of, a young team putting a lot of late night pizza nights on startup sprints. But also, we also needed a conservative, traditional risk management business that will require a lot of deep expertise. We also want our individual teams to be very focused, even though it seems at the corporate level, we are pursuing a lot of innovative growth developments at once. Second, the two aspects of the business have naturally different venture stage investors. Frankly, it's not easy to sell tech investors on an old economy hydrocarbon LNG exchange, and not easy to sell financial service or energy market traditionalists, focused on deep, on risk management, on deep tech investments, or nascent industries like carbon or smart contracts at their early innovation stage. And third, on a related cost of capital point, having the traditional exchange business split out separately allows us to finance it at a de-risk stage to users of the exchange who may value it more than simply passive investors. And we can structure the risk reward of that specific strategic stage, appropriately for these investors and the risks they're willing to take. However, we also know that to a large extent, a lot of our long-term success would come on the back of an exchange launch first. both as a first cash flow stream and to develop our brand and reputation. But the exchange could also be a first internal client of our technology and client, and be a client network hub to spread the technology business. So of course, 80 to 90% of our budget, our market communication, and our overall efforts have been on Abaxx Exchange and the LNG market needs first. But even though the exchange is right now, say, 80% of our priority, we built the two balance sheets in a way that affords us financing flexibility so that we can maximize our runway and minimize our overall dilution by pursuing the most advantaged cost of capital. And the royalty structure from our internal development companies allows us to pull forward potential cash flow streams, even while bringing in new subsidiary partners and growth capital, so that long-term investors in the SmarterMarket vision can be rewarded with a dividend cash flow, with a number of diversified cash flow streams for their long-duration capital invested in this innovation. I would say Base Carbon was a perfect example of the strategy. Base Carbon has a very different capital intensity profile from Abaxx Singapore or Abaxx Tech generally at this stage. However, we knew we were well placed to put together this venture and the high value formation of the business and long-term, and create this long-term valuable royalty for Abaxx Tech investors right from the start. If Abaxx investors generally were only looking at the exchange, that pursuit could have been seen as a distraction. But from a two balance sheet strategy, I see it as highly accretive to Abaxx Tech, the SmarterMarkets vision, and ultimately gives early exchange investors more runway and financing optionality to potentially lower dilution and increase investors' overall exposure to both the exchange and the technology vision. Base Carbon needed about $50 million to deploy into their first portfolio of projects to prove out the thesis we had developed. And it didn't make sense to dilute Abaxx Tech or Abaxx Exchange focused investors that early. And finally, it's important to point out that we can achieve a lot of early stage company economies of scale through centralizing a number of these corporate services across these group companies and centralizing and leveraging our brand and reputational, and relationship networks. But through separate balance sheets, we can focus this capital and attract the very best niche expertise in each group company while growing a large relationship network. I should point out that this model I borrowed heavily from the late great Lucas Lundin and what he was able to achieve at the Lundin Group companies to attract some of the best people in the industry into early stage exploration and development companies while each was in pre-cash flow. Nobody, I believe, has executed that model better, and the world is better for it. So with that background, where are the two balance sheets today as we move into our launch planning stage? The reason I spent so much time revisiting this capital strategy is that we are currently preparing both companies for a transition to a revenue growth stage in 2023, which also brings a new phase of thinking about capital structure, public listings, and strategic investors to get both companies to the next stage. At the Abaxx Singapore level, we are looking at our launch and regulatory requirements over the next 18 months and potential strategic investors positioned to grow that business. And at Abaxx Tech, we look to optimize the cost of capital to grow our broader SmarterMarkets thesis with the added income streams of both Base Carbon and Abaxx Singapore royalties kicking off as soon as the first half of next year. So at a high level, we want to give an introductory look at how we should break out the assets and opportunities and the cash runways and potential break-even modeling for both opportunities separately. In Abaxx Singapore, we have roughly $12 million in net working capital, and we're ramping up our spending to roughly $1 million per month. And I should note here, again, I'm taking a fairly high-level breakdown between the two. And of course, I'm using a US dollar, which is essentially our operating currency, even though we're recording the consolidated financials on a Canadian dollar basis. So we have roughly $12 million in net working capital in Abaxx Singapore and a roughly $1 million per month ramp up. We also require a minimum of roughly $16 million US dollar floor always on our balance sheet in Singapore for regulatory requirements once we take down the full licenses for launch. So from a working capital perspective, we have a runway of a bit over a year when isolating this business individually. And we should also note that the business could potentially be cash flow positive, as soon as 4 or 5 quarters after launch if we hit our milestones. But it will require more capital by Q1 for a healthy launch balance sheet and to meet regulatory buffers. Abaxx Singapore, the group will be running at about $250,000 US dollars per month, and has a net US $5.5 million position in cash and saleable investments, not including some of the long-term illiquid venture assets. We can also envision a cash flow break-even from the base carbon and Abaxx Singapore royalty income as soon as 2024 as well. So we are well capitalized at the technology and holding level business, given that runway. And we would look at ramping up other growth opportunities such as, the software as a service application business, Abaxx Singapore, and even our iron ore assets once we have certainty over the exchange getting up and running with a known runway, very soon. This flexibility and runway cover until we reach royalty cash flow break even at tech is also why we put in place the NCIB buyback in the case of extreme illiquidity, creating dislocation in our share and an opportunity to buy back a stock. For now, of course, before launch or before bringing in any potential capital partners at the Singapore level, we control both companies and therefore can look at our working capital runway on a consolidated basis, where we have over a year of ongoing working capital without needing to liquidate any base carbon shares, and what we believe is a lot of transformational events and de-risking of the group around the year, this fall and in early 2023. So we would only require raising additional regulatory minimum capital specific to a launch timeline that will be laid out. This is all to say that we intend to build up Abaxx Technologies, the listed shares from this point forward without parent company level dilution as a base case strategy, maximizing investor exposure to the long-term SmarterMarkets thesis, technology, royalty income, and hard assets, including our iron ore assets and their green steel potential. But of course, we've also optimized our financing flexibility and optionality so that we can sell shares directly to the public market if it represents the best access to capital, or sell a stake or dilute a stake in the Abaxx Singapore Exchange to a strategic partner, or sell venture assets off our balance sheets once we believe the early value creation has been maximized. But we wouldn't see any liquidation required until those businesses are fully up and running with cash flow. At the group level, we would want to see the market value the sum of the parts more in 2023 with the launch of the exchange, first cash flow from base carbon, and full unveiling of our ID++ technology application suite, and even progress some of the positive interest we've been receiving of late in our iron ore properties before we consider dilution of Abaxx Tech shares. As the largest shareholder, my personal view is that the market is probably placing a discounted present value at one, at most at one of our companies, but definitely not both companies at this stage. So my job as CEO over the next 4 to 6 months, during these transformational milestones across the group, is to realize our share value in both dimensions of the companies, and perhaps look at new exchange listings for one of the two companies if the timing and valuation is there in early 2023. I assume we'll have more questions on these points. So for now, let's turn it over to David for a market update, and then turn things over to Q&A. So again, thanks for the long script, and David, over to you.
Thank you very much, Josh. I'd like to take a few minutes before we dive into the Q&A just to give everyone an update on what we're seeing with our client interactions and how I'm viewing external events in our markets affecting Abaxx and our mission. As Josh said, it's been a very exciting and motivating summer. We've been out building global markets. From my side, I've been with the commercial team, meeting with leading market participants, kicking off the summer, going through London, Geneva, and Singapore, meeting with those market participants. And what we were doing was continuing the discussions around our LNG contract and introducing the design for our carbon futures contract. And personally, I had some concerns when we first went out that people would feel that some of those needs, particularly for the carbon market, had already been met. And so I couldn't have been more pleasantly surprised with the strong engagement and enthusiasm for both the carbon and LNG futures contract designs that we experienced in London and Geneva and Singapore, with multiple traders asking to be the first trade on the contracts when we launched them. I think what we experienced was, in conversation after conversation, market participants telling us that what's currently available to them is not enough to meet all of their commercial needs. And more importantly, wanting to work with us to build what is needed. And to me, that was the big shift in tone that I took away from those trips and those meetings. Was, previously I felt like some of the meetings were strong, but there's a type of meeting where it's, you've got my attention. Now I'm listening. And I felt like there was a shift in these meetings as well, and in some of the prior ones over the course of the year, to asking the detailed sort of questions that people ask when they're working through in their own mind, I'm planning on using this thing. Let's make sure I thoroughly understand it, and let's make sure it thoroughly works for me. So I think that's been the big shift that I would want to highlight that we've seen over the summer, is in addition to the engagement and enthusiasm that's been there, there's been an engagement to work with us to refine our contract designs, come to a reasonable consensus on what best meets the commercial needs of the markets, and to really be actively engaged, not a consumer of what we would provide, but an active participant working with us. And I think what that really speaks to is our focus on meeting the commercial needs of the market has really resonated across market participants and FCMs. And I think it's the experience of the team, and the experience of a team that speaks the same language and has been in these markets with many of these participants for decades. So we continue that work over the course of the summer. We continue it now. And that's, that level of engagement has been very energizing, I think, for the whole team. In terms of the Smarter Markets podcast, I think I see that working hand in hand with the mission of the exchange and the broader mission of Abaxx. That what we're trying to do is bring people together, attract an audience to our vision of using markets to solve the big problems facing the world, and to build a community of market participants that are engaged on the challenges, in particular, of the energy transition. And so what we've seen, over the course of this year and over the course of the summer, is that audience is growing, and it's leading to more engagement in terms of the commercial business as well. So it's a great way to let people know who we are, let them know who we care about, and bring them into our community and put that community to work. You may have listened over the summer. We had our summer playlist series where we had Jeff Curry back, Robert Friedland. We had Hannah Hellman from Trafigura, Michelle Dennedy, lots of wonderful guests. We've been doing our When Markets Break series, looking at market crises in the past and what we can learn from them and how we can build more resilient, smarter markets. And I think you'll, really enjoy and be engaged by the next series that we're putting out, which we're calling Winter is Coming, where we'll see energy market luminaries, including Daniel Yergin, speaking to what the winter outlook for natural gas and LNG will be, given all that's happened and is happening in Europe. And with that, I'd like to switch ahead to, let's look at the market events that we're in the midst of here. And, LNG is now very much front and center in the global energy security conversation, and its market dynamics are changing dramatically. And I think those changes in market dynamics, create a terrific opportunity for a new entrant to come into the market and meet those changing needs. Things happen so fast in the world these days. I think it's easy to forget if you went back in the LNG market 12 months or 18 months, the conversation was radically different. Back then, Europe was the sink. Europe was where excess LNG went to be disposed of. And now Europe is the strongest demand pull for liquefied natural gas, with natural gas prices over $85 in MMBTU this winter. I think we need to pause on that, $85 in MMBTU. In the US, it wasn't too long ago, we were $4 or $5, now heading up to 10 as that LNG gets pulled to Europe. Massive prices, massive need for risk management. The US is now the largest LNG exporter in the first half of this year. And the race to build import terminals in Europe and the ships needed to meet that need is going to require those better benchmarks and better risk management tools to unlock investment capital. So this expensive, volatile, vital market, is now front and center. It's what global energy security is about, what global security is about, and what the global economy is going to rely on. So a really amazing turn of events over the past year and a half, and just really has put front and center the need for the benchmarks and the tools that we're creating. And I think that is, a part of what's driving that high level of engagement that we're seeing with clients. The other, looking at the carbon markets, they continue to develop. Net zero pledges are now mainstream. It was only a year or two ago where, those seemed more located in the marketing department than the operations department. Now they're in the operations department and increasingly subject to regulation. So, companies are needing to treat their net zero pledges the same way they treat any other liability, and they're being held to account by governments. So this is a real thing. When we also look at, so when I put all that together in terms of the upshot, I think last time we spoke in May, what I emphasized was that what was happening in the market was a recognition of many of the things that we had been talking about and Josh had been pointing out for years. There was the recognition of LNG central importance. There was the recognition of the need for carbon markets. And that's all still true. But I think what we're seeing in addition to that now is that we're seeing engagement, that market participants and FCMs are now engaged in working together with us to create the better benchmarks, technology, and tools for risk management that are actively needed, urgently needed. So I think the difference now is you go from recognizing the problem to saying, okay, we got to work on this. And I think people are much more engaged in trying to, work towards those solutions. And that's fantastic because we need them quickly. And finally, there's that growing recognition that the consensus energy transition plan, which I'd say, could be put shortly as widespread electrification powered by low carbon renewables, that plan faces substantial constraints from the limited availability of metals and minerals. I think Robert Friedland pointed this out really well in the podcast we did with him over the summer. And he's being joined by other, important voices in the energy and commodities markets. S&P Global, under Daniel Yergin, put out a report over the summer, just looking at copper and saying, if you just look at the copper requirements needed to meet the energy transmission through electrification and low carbon renewables, we are short. And it's an existential threat because we're not short a little, we're short a lot. And I think Robert, not only agrees with Dan Yergin's assessment, but then also has pointed out the number of other places that is also true. And so, in these markets, there's a lot of investment that's going to be required and in a lot of different areas. And Europe is demonstrating the problem that comes from trying to transition to a new energy system that only has an inadequate supply base. So people are seeing the very real implications of getting the energy transition wrong. And I think it's focusing people's minds on the need to get it right and what we need to do to get it right. So, that's part of what we'll be following, I think both as a business and from the Smarter Market side is exploring, how do we get this transition right when plan A probably isn't going to be the one that works. So with that, that's kind of how I've seen the recent events and their market implications. And hopefully that gives you a little bit of a flavor of what we're experiencing with the market participants and FCMs that we're working with. And with that, I'll turn it back to Josh. Thank you very much.
Thanks, David. I'm now going to go through some of the questions that were submitted before the call, as well as from the chat. So if you haven't gotten your Q&A question in yet, please enter it into the chat now. Let's see. Moving to the chat. As you can tell, I'm moving a little slow this morning, but speaking a little fast. So I'll maybe kick the first question over to Joe. Talking about other products And if particularly given what's going on in the commodity world, if we're looking to launch a crude oil contract or other commodities.
Yeah, thanks, Josh. I saw that question in the chat, and it's a great question, and it just, I think, speaks to our model of looking at solving the issues in the marketplace, like we did with LNG and also with carbon, and engaging with the marketplace to find out collectively what do they need. We did it when Dan and I were at the NYMEX and the CME and launched significant amount of products, not ones that we dreamt up in our mind, but ones that the marketplace engaged us with. And I think we'll look at everything. We'll make sure that it meets the requirements of our regulator, the MIS. It meets our and satisfies our risk management policies. But we will look at products that are different, and I think that's what we did with LNG, and that's what we're doing with carbon. To what David said, the marketplace told us that our products are different, and we don't want to just list something that's identical or similar to what's out there already. So we'll look at all opportunities. We have a lot of inbounds already, as you mentioned, Josh. We had a leading mining company to ask us about battery metals, completely inbound cold call to us. As a result of our SmarterMarkets podcast. So that's resonating with the marketplace and giving us opportunities to engage with new participants that we might not have been speaking to before. So yeah, I would say, if there are products, we'll take a look at them and we'll add them to our list.
Excellent. Thanks, Joe. And I see a somewhat related question, can we get a name of these companies? So yeah, we actually want to be extremely, cautious here. Just developing all sides of the market, not just the upstream side, but the downside, the trading, the financiers. It's very important to build a market that's really looking at the interest of everybody. But again, I think at this point you can assume that we're in pretty regular discussion with the largest energy and metals and mining companies globally. So looking at I'm getting a lot of questions about investment partnerships. Again, naming some specific names. So again, we don't want to get into specific names right now, but very much like I mentioned on the on the diversity of participants, you'd also want to see diversity of potential stakeholders in the exchange and clearinghouse as well. So that would be upstream and that'd be sort of upstream producers and downstream consumers of commodities, financial institutions, perhaps some regionally, sovereign wealth funds, or focused on I guess more national priority for developing markets. So it's a little bit all of the above currently. But again, what we're looking at is we wanted to, again, fully de-risk the point through our regulatory licensing, through our technology, through our testing, through our engagement with the market. So that's where we believe we can create the most value for shareholders, through having this sort of venture capital runway that we built. So that when we present the equity of the exchange, it's not really necessarily on a risk-taking basis for partners to bring in, but really that they become transformational capital and additive to the success of the market. So we've been moving into that window, and so we'd be looking at an equity program this fall for some of those participants. Talking about the size of that potential, again, do you have a runway for the next 12 months and minimum regulatory capital? So again, in a base case scenario, before we take down the full licenses for launch, and get through that final de-risking, we do have plenty of working capital just as in the development phase of these businesses. Well over 12 months of general working capital. But as I mentioned in my prepared comments before, we do need we would require additional regulatory capital that we're looking at this stage. as most attractive to bring in capital partners into the exchange. But that said, we want to balance that potential strategic interest with obviously where our best cost of capital is. So we've built a lot of flexibility into our financing, and so we'll be taking into account both strategic reasons as well as cost of capital considerations in choosing the best path to raise that regulatory capital once everything's ready for launch. Again, somewhat related question. Are we open to having Abaxx accredited investors participate in future private placement and fundraising? So again, we would likely look at the exchange level with really just commercial participants and industry partners at that level. We would, but again, I don't want to take any options off the table, but we're not currently looking at any additional dilution in public markets. Can you disclose what the equity ownership in the Abaxx Exchange is today? So again, I kind of discussed at a high level how we look at the breakdown between the two balance sheets. And we've actually our current stake in Abaxx Singapore is 91%. It's essentially been the same for about a year now. So we did make an equity investment into Abaxx Singapore after our public market financing last spring, last summer. And that took us to 91%. So that has been unchanged because we did an equity investment at the time. But again, we have full flexibility right now for capital to be deployed on either side. But of course, we'll start having much more formal separations of those balance sheets and budgeting, particularly if we bring in external equity partners in Singapore. I think that's all on the balance sheet and capital side for now. There's another question for David on SmarterMarkets, or maybe a suggestion about please consider doing a summary editorial after each series, written with David or Josh. There's so much amazing content, but so David, maybe I'll turn this into a question for you. Do you want to share maybe a little bit where SmarterMarkets is heading over coming months and quarters?
Yeah, absolutely. And thanks for the suggestion and the kind comments. Yeah, so we're actually over the summer, we've also been in the middle of a website redesign for SmarterMarkets and expanding beyond the podcast to bring more content as well. So what we're looking to do as we move into the fall is bring keep the podcast going, keep the quality high, expand the network of participants and guests. But then also we want to make sure that those guests become a real community with us. And one of the ways we're looking to do that is also share on the website insights and commentary put out by our guests for all of you. And we want to also, increase the number of webinars and video events that we'll be sharing through the website as well. And we're going to call that SmarterMarkets Presents. And we've got a few opportunities lined up over the course of the fall that I think will be really exciting for people. So, look for that, particularly as we get to the end of September into October. In terms of the suggestion of, can we do more, a way to make it easier to remember some of the best of what was in each episode in each series, we're looking at a number of ways to do that. We're, working with another podcast host who has a strong journalism background, who might be helping us condense, 6 episodes down into a 30 to 45 minute highlight reel to help make it more digestible. We've also been working on creating transcripts and Q&As from each of the episodes that will be on the website in written form, which sometimes makes it easier to skim through and go back and find the important things that you remember but quite can't recall the exact details of. So those will be on there. And yes, I think your suggestion of, kind of reactions to the series or reflections on it is a great idea. That's one that we've been kicking around and just trying to find the best way to do it without distracting anybody from getting everything up and ready for launch. So yeah, please keep the suggestions coming in. We want to make this as accessible and as useful to all of you as we can.
Thanks, David. And probably one other note that I want to put out there is, we've been growing our listenership, both in numbers, but also I would say in influence and some of the types of listener, some inbounds from both corporates and prominent executives in various various boards and companies. And so there's been a lot of questions on, are we going to monetize this? Is this just an advertising spend? And one of the things that's I think very important is just to keep that intellectual integrity of what we're doing. So we've done this more or less ad free. We have obviously promoted some upcoming series and our and our spin out company Base Carbon to help get them on the map. But in general, we've been trying to keep this, as both Dave and I come from a financial institution research background. So again, we want to maintain always very high quality integrity. But that said, there could be partners within our ecosystem that we may want to start actually monetizing or at least covering some costs through also giving them a platform. So these are sort of things we'd probably look to next year as we continue to sort of develop the business lines of what I was saying is sort of two companies or two balance sheets. So there's not any immediate need to monetize SmarterMarkets, but we are building, I think, a fairly influential media brand within our industry. So yeah, again, as you can imagine, there's a lot of diverse questions on different aspects of the business right now. So I'm going to try to keep try to summarize some of these. But again, there's some more questions specifically on the uplisting of shares in other markets. So again, this is something both for I guess regulatory and forward-looking reasons we really can't get too specific on right now. But in general, what we're looking at of course is the NEO has been very look, they've been a very good partner, and we've liked supporting a challenger exchange themselves. And so we've had a very good relationship with the NEO. But I think the reality of particularly small cap Canadian markets is just how illiquid they are. We've seen some very large price swings in both Abaxx and Base Carbon between various markets, OTC listings in the US and so forth. Which again, and even the change in our market cap, both up and down, has typically been driven on really in the broad sense capital markets pocket change. So we do look at as we grow our company into the revenue stage, we do want to look at more liquidity options for our stock to better reflect the value and the broad the broad views of the marketplace. There's a couple questions about Abaxx Verifier and ID++ and our technology. Of course, we haven't focused so heavily on this quarter on that. Given all of the planning of the exchange, but I would say that we continue to enterprise hard in our Abaxx Verifier and the ID and digital signature aspects that we'll be building into our technology stack. But we're actually, this is a technology that's not necessarily, like the market participants are not going to have to use Verifier, in day-to-day trading or anything like that. So again, we've been building this as an ancillary service that's sort of embedded into the technology, both for security reasons in managing data and customers. So sort of on the back end side, we built it in, but it's not necessarily needed in the call it the front office of trading just yet. Now, again, with some of our innovations, particularly in contracts, we could introduce that down the road, and we think it'll be important to have those digital identity and digital signatures when we get to the point of, essentially, call it tokenizing, title or bearer certificates to be used as collateral on the exchange or going into delivery. But again, and there's some questions in here relative to the regulatory aspects of that. And again, this is all work that we've been doing, to be, ready for a next phase of, of these markets. But this is not something we've got into the details with our regulators right now. So again, it's built into the system, and we're enterprise hardening the applications, but they're not going to be required, to participate in the exchange. And we've not gone to the next stage of taking these through the regulatory process yet. I would say that's something that's more post-launch, being a priority, that once we've launched, we can very quickly get out and innovate afterwards. So that's sort of the thinking currently. Yeah, the questions keep coming in, so it's going to be kind of hard to keep up with all these. Some questions on base carbon and carbon markets in general. Cover a couple of those. I know we're getting to the top of the hour. So one of the questions is the relationship with base carbon going forward, and then another. Yeah, so maybe I'll tackle that first. So again, we still have a very collaborative relationship with base carbon, but really from the exchange perspective, there really isn't any sort of day-to-day link. And I would say that they're still very focused right now on the deployment of the first 50 million US in capital, to sort of prove out the thesis. Again, the base carbon model being very much, an upstream developer versus the marketplace model that we have at Abaxx. And so really the plan with base carbon is to deploy the first 50 million, show the ability of the team to source projects, but also source long-term offtake partners. Again, these being sort of tier one banks and commodity companies primarily. And so that's really the first stage. So they are looking at some technology pieces as well, but I would say that's further down the line. So really we really collaborate in that Phil and Michael and their teams really have great connectivity to the global commodity markets, given their own backgrounds at places like Goldman and JP Morgan. So there's a lot of network collaboration. But I wouldn't say there's specific business collaboration right now. So it was very important that we didn't dilute, either our focus or our capital by running that all on our balance sheet. So that was kind of the reason for the spin out. On voluntary carbon markets in general, there was a question. Can we do a long form rebuttal to John Oliver's piece on HBO the other night? Look, of course, I'm opinionated and probably could, but for the most part, there were aspects that we would actually, likely agree with are risks in the market of greenwashing, particularly in some of the Red Plus projects. And I think Phil from Base Carbon has been pretty outspoken about the risks of some of the projects out there. So look, this is still in a very early stage. But my big rebuttal is, not what the thing that I really don't like about some of the mainstream discussion of carbon credits is that there's some kind of sin tax, right? So first off, using energy, which is our main use of a release of CO2 in the atmosphere, is not a sin. And so this idea that fossil fuels are bad and that this represents a sin tax, I think is just a terrible framing of what carbon finance is all about. Really what it's about is taking capital from the return, the energy returns of the energy industry and continuously funding it back into decarbonization technologies and really industrialization and development, rather than just carbon offsets. So as an example, you look at something like the solar industry. The solar industry, when it first started, needed that carbon finance and those environmental, finance to really jumpstart the economies of scale of the industry. But over time, it really didn't need them at all. So really, what this is a very macro financial mechanism of taking returns from one industry and kickstarting a next. And that's why we're so excited about carbon finance. It's not about sin taxes or selling as some of the investors were saying magic beans. This is a very important business model globally. To jumpstart the investment need in these projects. So even when we look at base carbon, we're not really looking at it as a royalty company or even necessarily a commodity company, but a facilitator of those capital flows. So we've been looking at the base carbon level. They've been looking at some very interesting projects that again, utilizing that carbon finance with partners can jumpstart a whole new industry that would stand on alone, very much like the solar industry. So I think those are some very exciting parts of carbon finance that are very underappreciated, at the mainstream level. I would also say that, when base carbon went public, we were expecting much more interest and even retail investor interest in this emergent sector. But really, what we found over the first 6 months, albeit of course in a generally a bear market for small caps, what we found in the first 6 months is both the financial media, a lot of retail investment advisors, a lot of investment banks, really don't get it. And so, I still think we're very early and there's a lot of education. And of course, through SmarterMarkets and through, just our culture and generally, we want to be doing, providing a lot of that education over the next year or so. Let's see. I noticed we've gotten past the top of the hour here. Let me just skim through for any other final questions. And I should say again, because this list is growing, we'll endeavor to get back to these questions, both in future calls, as well as if you email into IR if your question has not been asked. I guess finally there's a couple questions about iron ore. So again, as you know, this has not been a priority, given the balance sheet that's needed to develop iron ore assets. But that said, we have been seeing increased inbound around our green steel and iron ore thesis. And so this is really something that we'll probably look at next year, and start some long lead time development there. Dave or Joe, is there anything else in particular that's standing out that we haven't answered from your perspective?
I think obviously giving as much information as we can on products without being overly too descriptive, given the competitive nature of the markets, I think we've answered those. I think one interesting thing that we're involved in. Somebody asked a question about events this fall, and we'll be pretty active at APEC, which is a big Asian or global energy gathering in Singapore towards the end of September. We were asked by WEMAR, the Women in Mining and Resources Group, which is a global group to promote the advancement of women in natural resource markets, to present at their conference in Singapore on the 27th of September. Dave Greely is going to be doing 2 out of the 2. They only have 2 sessions of a panel, and Dave's going to be doing both of those as a moderator. And there's some significant high-level women in natural resources markets that are attending that. And I think it's just a great platform for us, great platform for really raising the visibility of women in the marketplace, and it's also to really showcase Abaxx as a leader in this group.
Great point, Dave or Joe. Thank you.
Yep.
Great. Well, again, thank you for all your great questions, and we'll look to engage these over the next few months, and thank everybody for their time today.